Good morning, everyone. Thank you again for your interest in this investment opportunity. I know that we give you a lot of data. You might feel overwhelmed. So we also receive a lot of questions about how do I actually look at the return? It doesn't seem like very, very high, right? So a lot of them is because you're not familiar with the return calculation and you're not from finance background. So let me give you some concrete example to walk you through what is the right way to look at the return. So as we show on our underwriting model, we actually present every single way to calculate return. Some of them are very naive, simplified way to calculate it, but we provide it anyway. Some of the return calculation are more comprehensive, more accurate, provides apple-to-apple comparison between different projects in our view. So we will tell you exactly how each return measure is calculated and what is the drawdown of each one of them. All right, let's start with ROI, return of investment. So this is a very simple way and very intuitive way. A lot of people doing the math calculation in their head is actually using this one. So how do you calculate ROI? ROI is using your whatever you get divided by whatever you invest, right? So very, very straightforward, very, very simple. Okay, so let's look at two hypothetical investment. To make it comparable, let me just show you. So first, investment one, year zero, meaning now we invest 53K in investment one. And then let's say year seven, you get 5,300. So using the ROI calculation, whatever you get, that's the 5,300 divided by whatever you pay, whatever you invest, that's 53,000. So that you get 10%. Okay, simple enough. All right, second project. You invest today with 53K, and 1 year later, you get exactly the same amount, 5,300. As you can see, over the course of 7 years, total cash flow you get is the same, 5,300 for both investment. The only difference is the distribution of the cash flow. When I say distribution, I mean the timeline that you get your cash flow. So is it in year one or is it in year seven, right? So the only difference is year one versus year seven, right? So the not so sophisticated investor would say, well, I don't care as long as I get the same amount. But you do care because first, the further you get your 5,300 back, a lot of things can happen in between, right? So, I would say that in general, the further you get your cash flow back, that means a lot of things can happen. Your risk is higher. Let's just say that the risks are the same. You can still get that 5,300 with guarantee, right? So it still doesn't make sense to get it back later. Why? Because every year there's inflation, right? Even if not talking about the 2% CPI, we are talking about opportunity cost, meaning that when I get back the 5,300 in year one, I can immediately invest it in other opportunity. I can keep investing and then getting the return. However, in project one, you get the 5,300 in year seven. That means between year zero to year seven, all the money are locked up in this project. So you cannot free your money and invest it into other projects. So that's the opportunity cost, right? So this is the example that I want to show you that money has time value. This is very, very important concept, and it's actually 101 in finance. So you have to realize that not only you are comparing the amount, It's also very important when you get it back, because everything has to be discounted, right? You're getting the same amount in year 1 is different from you're getting the same amount in year 7. So I hope this helped. This ROI, although it looks the same, it's definitely not the same. All right, moving on. Another way to calculate return is called IRR. It's widely used return measure, and it's more comprehensive and more accurate way. And it compares, it actually is apple to apple comparison between different projects with different profile, with different investment horizon, with different cash flow distribution. Now let's make it more complicated example. So investment 1, right? So again, it's 7-year project. Now this is more like a very common multifamily project, but I just extended to 7 years so that we can easily compare, right? So the cash flow are here, right? So cash flow by year. So the orange one are the multifamily deal usually. So today you invest 53K, and then every year you get, for example, 6% preferred return. No, all these are made up number, but it's ballpark right? So you get 7 years preferred return. Each year is 6%, right? So that gives you 3,180 per year. At the end of year 7, let's say they exit it, meaning selling it, and then they first return your principal, which is 53K. And then they also give you a pie of the upside. Here, I'm actually being very generous. I said, okay, give you 21%, meaning that the upside that you can get is 40%. Very, very generous, right? Okay. So now, if you sum this up, that means in year 7, you're getting 77,380. So if you just do the simple sum up, you say, oh, I am getting 96K from year 1 to year 7. Okay, now look at the ATM deal. So these also are the numbers that's close to what we presented, right? So today you invest 53K, and every year you're getting 21% of this investment. So every year it looks very boring. It's always 11,000-ish, right? So that's the blue line here. As you can see, their cash flow distribution are very, very, very different, right? So the orange one, which is the standard multifamily deal, so they have very tiny cash flow before sell. In year 7, that's the sell, right? So I break it down. The blue part is the preferred return, which is 6% every year. And then principal, that's getting your original money back. And then the upside. Upside here, I'm using 40%, which is very generous. Okay, now, investment 2, you have the same 53K invested at the beginning of the year, meaning now. Okay, now every year you're getting the same blue bar, which is 11,000-ish. So some people always say, where's my big chunk of money in year 7? No, you are actually getting it back throughout 7 years. You are not getting a big chunk of it. Okay, so now it's different cash flow. So, but which one is better? First of all, as we mentioned that the money has time value, right? So yes, we are all very excited about the spike in year 7. 2 questions we have to ask ourselves. First is that how likely we can get this big chunk of cash flow in year 7. As I explained, between year 0 to year 7, there's a lot of uncertainty, right? A lot of uncertainty. Can we get that back? With what probability? You have to ask yourself. So things that you need to consider. First, all the real estate deal, they involve 60% to 80% loan to value, meaning that they use leverage, right? What does that mean? Meaning that anything goes down, the bank take over the property. You are being compensated after the bank. Okay, so what does that mean? Meaning that when bad things happen, you probably can lose your principal. So that puts a question mark of this big chunk of orange on the right-hand side. That's your principal. Okay, not to mention the gray part, which is the upside, right? Because if you lose your principal, there's no upside for you, right? Okay, let's say there's no losing principal, but the market is still not good, right? In year 7, if that is the case, then probably the property will not sell at the expected high price. So you ended up, okay, selling at still making money, but less than that, right? So then this gray part, how big is that? That's also, you need to put a question mark there. What's the probability of making the projected return? So that one you also need to ask yourself. However, in the ATM deal, we don't bet on one single year because if your cash flow is highly concentrated in 1 year, what happened in that year actually can greatly affect the whole performance of your investment. Let's say in year 7, if COVID happened, that could completely destroy your deal, right? But in ATM deal, it basically spread your bet within 7 years. You don't heavily rely on any single year. So that's the diversification benefit of it. Second, we also answer the question of how likely, what's the probability of actually earning this cash flow each year. In the presentation, we show with the historical data, the cash demand and the transaction volume is so predictable, basically like a clock. If you forget the data, you can go back to the PowerPoint or the PPT or the video to look at the data. By the way, all the data we presented there are from US Treasury or other very formal website. So we are not quoting the data from some random newspaper you never heard of. We are using official data, like from the government, right? So I hope I've addressed the question here. First is that, are you highly concentrated your cash flow in 1 year? If that is the case, you have to ask yourself, how likely I will earn this cash flow? Is it possible that anything happen that I may lose my principal, or even without losing principal, what's the probability of me earning the upside, right? So with the leverage, there's a risk of losing your principal. The ATM deal, as I mentioned, the deal has no leverage. We are not leverage. Prestige is not leverage. The whole deal, there's no leverage, meaning that you are the first one getting compensated, no bank in front of you, and you are the first one. The manager, the sponsors, everybody get compensated after you, right? So that's why the manager will be motivated to make it work, because they don't get compensated if you don't get compensated, right? So, okay, now, after we talk about how likely that you can earn this cash flow in year 7, now let's look at what is the right measure to calculate the return. As I mentioned, the IRR, it's called internal rate of return. It's a widely used return calculation in financial industry. It provides an apple-to-apple comparison between different projects with different cash flow profile. It can be a project with 3-year horizon versus another project with 7-year horizon. It can compare the project with even distribution, cash flow distribution, versus something highly skilled towards the end, right? So it basically, compared to ROI, it basically take into account the time value component. So that means $100 today definitely worth more than $100 2 years from now. So it basically assigns different weight to the cash flow, depends on when you receive it. So here in Excel, you can actually use this formula, right? So this row is all the cash flow from year one, assuming that you can get all this previously projected cash flow in year 7. Now, we are assuming that you are getting it back. What is the IRR calculation? Okay, IRR calculation says this is 10%. Okay, now look at investment 2. Again, we are doing this IRR calculation, and then what does that say? It says 11%. Why is that? The reason is because you are getting more cash in the near future than in the back, right? So $100 today worth much more than $100 in the future, right? So you can also see it from here. If you just naively sum up all the cash flow, the first case, it will tell you, oh, we are making 96,000. Not making 96,000 because they are returning your principal. That's 53,000, right? So, okay, this is not what you're making. This includes your original investment. Let's just say, okay, 96K is the total cash flow among 7 years for investment 1. Same calculation. If you sum them up, all the cash flow, investment 2 give you only 77, or let's call it 78K. It sounds less exciting, right? But this is not the right way to look at it. The reason is because money has time value. That's 101 of finance. So IRR take care of that. So that's 11%. And don't forget, they are not apple-to-apple comparison because investment 2 has no leverage. Investment 1 has leverage, meaning that it's not the same type of safety because in investment 2, you are the first one getting compensated, yet investment 1, you are after the back, which give 60% to 80% of the project, right? So with leverage, all the return basically is magnified, right? So even after magnify, it's still just 10%. This one without magnify is 11%, right? So I hope that I explained this well. So now let's move on to the next one. Someone asked me, how do I know whether this is a Ponzi scheme? You can do some research showing that there was some case many years ago. Someone raised capital for ATM, saying that this is a lucrative business, and actually it turns out that's a Ponzi scheme. What is Ponzi scheme? So whoever that promised you that they can give you a high return, they are actually not generating from business. They are actually generated from getting the money from new investors and then use that money to pay the old investors. How do I know that this one is not the case? We don't, right? So we just try to provide you the evidence, and you have to make your own decision. So how do we know whether this is a real deal or not, right? So the first concept we want to show is IAD. What is IAD? IAD is called Independent ATM Deployer. So basically, this ATM management company is called Paramount. Paramount, basically, you can imagine is an internal, like an in-house property manager for Prestige, if you want to think of that way. So the banking sector is highly regulated, and if you are going to be the owner-operator, meaning this Paramount type of role, you will need a sponsor bank to do so. You cannot just buy an ATM and say, hey, I have the money here, like I will charge you $3 per transaction. You cannot. You have to associate with a bank, right? So this sponsor bank require you to provide third-party accountant, financial audit, and then submit the reporting every 2 to 3 years. You have to pass that audit in order to be sponsored, sponsor, right? So in this case, Prestige sponsor bank is Meta Bank. They are also the issuer of stimulus package through EBT card, which is a big thing right now. So after COVID, a lot of government stimulus is actually sent out through this EBT card. The sponsors bank basically put their license on the line and pretty much said Prestige is under their umbrella and they're in compliance. So I hope that can tell you that whatever they pay you, it's actually from the real business and someone actually looking out for you. So that's one angle to answer your question about Ponzi scheme. The second question is that we have the client. So if you're in New York City or New Jersey, I will highly encourage to go to the following stores in New Jersey, right? So for example, all the McDonald's in New York City, they are actually client of Prestige. You can go there and check it out, their ATM there. And yeah, what's not mentioned here is that New Jersey Turnpike and Pennsylvania Turnpike, they are also the client of Prestige in Paramount, which is their ATM management company. Okay, the third evidence I can provide is that our consultant team did the due diligence on their own. What that means? That means they actually went through the locations in 3 states and then actually see the actual location contract with the store owner. Those are not the copy of PDF. Those are the actual paper contract. They see the in-signed contract, meaning that they can actually see people signing there. So I hope this helped. Those are legit business. There's something behind it to support that. Although you don't see it, actually there's a team working dedicatedly for you to address your concern. The last one I want to mention, because we only have 1 hour to present the night before. So we focus on the boring part, which means only the transaction fee part, because a lot of people have questions about that. We also want to say the reason that Prestige want to use the money from investors to invest is because they want to get to the future. They want to grab the market share before it's taken over by other competitors. So what are the exciting upside that we are talking about? Note that we didn't include any upside numbers in our underwriting model. So when we said 11,000 you're getting, it's purely from transactional base that we know with very high confidence based on historical data that you can get. But we are not assigning any number from the marketing revenue. Know that if they do have marketing revenue, you get 12% off it, but we're not including in our model. Okay, so let's take a look at what is the application of it. So I have some data. So know that in US, this application are still in its infant stage. So it's not, you can't see it everywhere. But in Europe, actually it's very, a lot more mature than US. That's exactly the point. Prestige want to grab the market share before everybody knows it, right? So then besides the boring part, do you want to be part of this upside or not, right? So let me show you some upside. Okay, so here. Okay, this is the paper published by Paramount, which is the ATM manager, right? So it says Paramount partner with this credit union to roll out digital media solutions throughout locations in New Jersey, in New York City. You're encouraged to check it out. So note this ATM. Those are not the old ATM that you think, those gray box can only get the cash flow, right? So no, it has a gigantic screen So that's why they will have a lot of advertisement there so that you can make money. And then they also have some software that Prestige design, which will allow it to have a lot of functionalities, which is not in the old generation machine, the gray box, right? Okay, so what are those implications? Okay. So, for example, imagine it will have a standalone video topper, which we just talked about, right? So they can show the advertisement. It also says it has a built-in camera that's connected to proprietary software, which allow the system to capture the data regarding the profile of the customer, but without recording the person's image or other personal information, including gender, age, and other demographic information, such as traffic stored by day of week, time of day, weather, and other parameters. So what do they use this for? They aggregate it, and then they use that as like a marketing tool, right? So they can sell that data, analytical data, to some company. But of course, this is at aggregation level, so no privacy will be violated. The system can run advertisement and then display on the screen we already talked about. And then it will also show, let's see, right, showing the app, right? So this is one way of doing it, right? So let's see. Okay, so here, there's another usage. I don't know about you, but our company also have the ATM in our office. So the employees, you don't have to go to the branch or go to other location to withdraw the money. You can simply just withdraw the money in the office. So this become more and more common. So for example, in the hospital, that's actually helpful because in COVID, you don't want the doctors or nurses go out to withdraw the money, right? They can just simply doing this in the office, right? So that's the actual hospital that they partner with, okay? Right, so this program is called Cash at Work, right? So you see this, that's what I'm talking about, right? So we, in office, we have this. Okay, that's another application of this new machine. It basically can partner with the gift card, right? So you see all this gift card, you can actually use the app to use that gift card to withdraw cash on the ATM machine. So as you can imagine, a lot of things, right? So that's why we said that ATM, this new generation of ATM can coexist with technology. They will not die with technology. They are not the cash dispenser only. They have a lot more functionality. And if you do enough research, you will see a lot of new application in Europe. US is catching up. So again, this is an opportunity we think that provides you a adjusted risk return reward. What does that mean? The downside is protected based on all those historical transactional data. It's like a clock, right? So it will give you the money every month with the same amount. However, there's upside potential, which right now we cannot correctly give you an estimate because that's tomorrow, right? So any number we give you, that will be irresponsible, right? But you do need to believe there's a potential, right? And it's already realized that in Europe, US is catching up. If you want to be part of it, you may be interested in investing in this opportunity. I hope that addressed all your questions. So I do want to remind everyone that today at March 10th is the last day for verbal commitment, meaning that today is the last day you have to let us know that you want to invest without wiring the money. today is the last day. We have to tell the sponsor that how many people here are interested in. We have to let them preserve a spot for us. Then, if you let us know, we will preserve the spot for you. After that, we will send out the legal doc. You will review everything. It's 100 pages long. It defines everything, so you are well protected. And then after that, we will sign it, approve it. You have to provide the letter to show that you are accredited investor. Last night, we already sent out that email. Basically, there are two ways to prove you are accredited investor. The most easy way is to go to your accountant. We have a template for your accountant to fill out to prove that you are accredited investor. If you don't use accountant, another way, also very, very easy, is to go to a website called www.verifyinvestor.com. They have all the accountants and attorneys to review whatever document that you provide, and then send you the certification, prove that you are accredited investor, and the valid period is 3 months. Yes, you do have to pay for it, unfortunately, but that's the way that you can get into the deal. So we do need you to be accredited investors. Otherwise, you cannot participate. I hope this answers your questions. If you do have additional questions, please reach out to us, Yan at Sharpe Investor Group or Henry at sharpeinvestorgroup.com. We hope to address the question as soon as possible, but please do remember, if you want to be part of it, today is the last day for verbal commission, verbal commitment. Thank you so much for your interest, and I will see you there. Thank you. Bye.